Okay, let's get into it. We are diving into the Q3 2025 earnings for Lifetime Group Holdings Incorporated. And wow, this wasn't just a solid quarter.
No, not at all. This felt like the execution quarter, the one where they really proved out the strategy.
Right. We saw, clean beats everywhere you looked. A pretty hefty lift in their forward guidance.
And the market definitely noticed a really strong positive reaction almost immediately.
So our mission for you today is basically to unpack what's driving this. We want to look at the financials, sure, but also the strategy, especially around club growth and getting more money out of those existing clubs.
Yeah, digging into that premiumization angle. Let's start with the headline numbers because they were pretty surprising.
Okay, lay it on us.
Well, non-GAAP adjusted EPS came in at $1.41. Consensus was looking for what, 34 cents?
So at 30.44 expectation, they hit 0.41. That's like a 21% beat. Pretty substantial.
Yeah, a really nice surprise there. And revenue followed suit, $782.6 million.
Okay, and the street was at $770.3 million.
Right around there, yeah.
Yeah.
So comfortably ahead. And that's up nearly 13%, 12.9% year over year. So good momentum.
That year-over-year growth is strong. It shows it's not just, a one-time bump.
Definitely. But the efficiency, I think, is where it gets really interesting. Adjusted EBITDA hit $220 million.
To 20 mil. And that's up how much?
Up 22% compared to last year. And importantly, the margin, the adjusted EBITDA margin, improved by 210 basis points.
Okay, hold on. 210 basis points. So 2.1 percentage points better margin.
Exactly. Now sitting at 28.1%. That tells you they're getting more profitable on each dollar of revenue.
Which is huge. That's operational leverage kicking in, right? Getting more out of their existing setup.
Absolutely. And you see that flowing into the clubs themselves. Comp center revenue growth. So existing clubs was up 10.6%.
10.6% from established locations. That's impressive. Driven by what? Mostly dues?
Well, both, actually. Strong performance in dues and those in-center businesses like personal training.
Okay, let's touch on net income. It was up massively, right? Like 147% year over year to $102.4 million. Sounds almost too good to be true.
Yeah, you got to unpack that number a bit. It's strong, but there were some, let's call them helpers in there.
Ah, okay. What kind of helpers?
So at $22 million, give or take, came from some smart financial moves. There was a $5.7 million gain after tax from a sale-leaseback deal.
Right. Selling a property and leasing it back to free up cash. Standard playbook for them.
Exactly. And then another $16.2 million, also tax-adjusted, from those employee retention credits, ERC, the pandemic era stuff.
Gotcha. So good capital management definitely adds to the bottom line, but maybe not purely operational growth driving that full 147%.
Precisely. But the core business was strong enough for them to feel confident raising the full year guidance pretty significantly. And that's what really got investors excited.
Okay, so what did the new guidance look like?
Revenue guidance got bumped up, now expecting $2.978 to $2.988 billion for the full year.
Okay, a bit tighter and higher than before.
Yep. But the real vote of confidence, I think, was adjusted EBITDA, raised to $820 to $824 million. The prior range topped out at $815 million.
So pushing through that previous ceiling. Nice.
Yeah. And they also lifted the comp center growth guidance again, now looking for 10.8% to 11.0% for the year.
Okay, this kind of flows into what you mentioned earlier, this membership optimization idea. It sounds like more than just raising prices a bit.
Oh, it is. It's a deliberate strategic shift. They're moving away from just packing the clubs, maximizing the sheer number of members.
Oh, to what then?
Towards maximizing profitability and engagement from the members they do have. It's about quality over quantity, essentially.
And you see that in the numbers.
Clearly. Average revenue per center membership, up 11.3% year over year. It's now $907.
$900 per membership on average. How are they pulling that off?
Well, they're actively managing the mix. Trying to attract more couples and families, they pay higher dues, around $218 a month on average.
Okay, so tilting the mix towards higher paying demographics.
Right. And crucially, they're actually limiting the number of lower priced memberships or those memberships paid through third parties, especially in their busiest high utilization clubs.
So they're willing to turn away some volume to protect the experience and the price point for the premium members.
Exactly. And it doesn't seem to be hurting engagement. Average monthly visits per membership actually went up slightly, 5.9%, hitting 12.5 visits for the quarter.
12.5 visits a month per membership. That's almost 3 times a week. That seems incredibly high.
It is high. very engaged user base.
Is there a risk there, though? Like, if everyone's going that often, are they hitting capacity walls in some places? Could that make it harder to add new high-paying members if the clubs feel too crowded?
That's definitely the balancing act. Management seems aware of it. Their argument is that by limiting those lower tier memberships, they are managing utilization to keep that premium feel.
Yeah.
They want the folks paying top dollar to feel like they have access.
Okay. And maybe the answer isn't just fewer people, but bigger spaces, which kind of leads into the growth plans.
Perfect transition, because the growth story is accelerating, and it's based on a new type of club. They've set a new baseline, 12 to 14 new clubs per year starting in 2026.
12 to 14 a year, that's a step up from their recent pace, isn't it?
It is, and they seem pretty confident they could hit it. For 2026, they said 13 of the planned 14 clubs are already under construction.
Wow, already building for 26. And what kind of clubs are these?
Mostly large format ground-up builds. 11 of those 13 are the big ones. And get this, the profile of these new clubs is changing.
How so? Bigger? Smaller?
Bigger, much bigger. Average square footage for these new builds is 94,000 square feet. Compare that to the average of 66,000 they were building in 2025.
94,000 square feet. That's huge. So packing in even more members?
Actually, no, that's the twist. They're targeting fewer members for these giant clubs, aiming for around 3,500 to 4,000 members.
Wait, bigger club, fewer members. Why? That seems counterintuitive.
Because the space isn't just for workout equipment anymore. It's optimized for those high-revenue ancillary services. More space for personal training, more space for their Mura longevity clinics, bigger cafes, spas.
Ah, okay. So fewer members paying higher dues, but way more opportunity to spend extra money once they're inside the massive facility.
You got it. It's about maximizing the total revenue potential of the real estate asset, not just the membership count.
And they're funding this faster growth. How? Is the balance sheet holding up?
Seems remarkably strong, actually. Net debt leverage ratio is under 2 times.
Sub 2x leverage while accelerating growth. That's pretty good discipline.
Yeah, and they have plenty of liquidity, around $837 million. Plus, they just got an upgrade from S&P on their issuer rating up to BB. The credit markets like what they see.
Any other capital moves?
They're being smart about debt costs, too. They repriced their term loan margin, save himself 25 basis points.
Nice little saving there.
And here's that financial engineering again. They plan to do another $55 to $65 million in sale-leasebacks in Q4.
So build the valuable asset, sell it to unlock the capital, lease it back, and immediately plow that cash into building the next club, all while keeping debt low.
It's a pretty slick cycle they've got going. Build, monetize the real estate value, reinvest, repeat.
Okay, let's shift gears slightly to those non-dues revenues, the ancillary flywheels, as they sometimes call them. How's that side looking?
Really strong. In-center business revenue grew 14.4% year over year. And the main engine there is dynamic personal training, DPT.
Personal training is really driving that much growth.
Apparently so. Management sounded super bullish, said some trainers are totally booked solid, shows the demand is there.
So the focus is just hire more good trainers.
Pretty much. Adding productive trainers, getting the most out of that service everywhere. They did mention they expect other areas like the cafes and spas to pick up momentum early next year. Sounds like some new initiatives coming there.
Okay, what about outside the physical clubs? Digital stuff?
Yeah, they're pushing there too. They launched something called LAI.
LAIC, what's that?
It's their AI wellness companion. The idea is to use AI to deepen engagement, maybe cross-sell services digitally. And they have a big audience to work with, 2.75 million non-club digital accounts.
2.75 million digital accounts. That's a massive funnel, even if they're not members yet.
Huge potential reach. And they can use that to push their own products, like the LTH nutrition brand.
Right, supplements and things. Anything new there?
Yeah, they just launched LTH Dream. It's a sleep supplement, but melatonin-free. And they made a point of emphasizing the quality control.
How so?
Rigorous third-party testing. They're clearly trying to position themselves as the premium, trustworthy option, especially with all the, contamination scare you sometimes hear about in the supplement industry.
Makes sense. Leverage the trusted brand name for premium supplements. Smart.
Enough. And then there's the really high-end stuff, longevity and wellness, the Mura clinics.
Ah, yes, the longevity offering. Are those expanding?
Big time. Plans to open 4 or 5 new Mura locations just in the next 90 days. And they flagged aggressive expansion for Mura in 2026.
So really leaning into that whole athletic country club meets total wellness ecosystem idea.
Exactly. It justifies the premium pricing and differentiates them further. And Wall Street seems to be buying into it.
Yeah, you mentioned the market reaction. Any specific analyst calls?
We saw some upgrades. Morgan Stanley, for example, moved to overweight. And if you look at the average analyst price target, it's around $39.23.
$39. What's the stock trading at now? Mid-20s?
Somewhere around there, yeah. So the average analyst sees like 50% upside. Clearly, the belief is growing in this premium asset-focused strategy.
Okay, so that brings us to our, let's call it the interesting ideas segment.
Right, the part where we put on our slightly more speculative hats. Remember, everyone, what follows is absolutely not financial advice.
Seriously, just exploring possibilities based on the quarter. Do your own research. But given the execution, the guidance, the strategy, there might be a leveraged way to think about this.
Okay, so the thesis is management keeps executing flawlessly on this premium real estate and growth plan, and the valuation catches up to where analysts think it could go.
So, the pitch.
Okay, here it is. Consider buying 1 year out of the money call options, maybe targeting a strike price somewhere near that $39 analyst consensus target.
Whoa, OTM calls. That's definitely a leveraged bet. You need the stock to move significantly, and within a year just to break even, let alone profit.
Exactly. High risk, high potential reward. It's a bet on continued near-perfect execution over the next 12 months.
So what needs to happen for that kind of trade to even have a chance? What are the key catalysts?
I think it rests on three main things. First, they absolutely have to deliver on that accelerated 2026 club opening schedule. All 12 to 14 clubs need to open on time. That proves they can scale this model effectively.
Okay, operational execution on growth. Makes sense. What's number two?
Second, they need to nail those Q4 sale-leasebacks. Successfully pull in that $55 to $65 million. That reinforces the balance sheet strength and proves the capital recycling engine is humming along smoothly.
Right, keeps the funding flowing without adding a ton of debt. And the third catalyst.
Third, we need to see real, measurable results from those new ventures. LAIC, the AI companion, needs to show it can drive engagement or sales, and the Mural longevity clinics need to show traction as they expand.
Basically proof that these ancillary services aren't just ideas, but are actually adding meaningful, high-margin revenue. That would validate the whole premium ecosystem concept.
Precisely. If those three things happen, on-time club openings, successful sale-leasebacks, and tangible results from new ventures, then maybe, just maybe, that $39 target starts looking achievable within a year.
Maybe. Again, emphasis on maybe. A lot has to go right.
Absolutely.
Yeah.
Cannot stress this enough. This is purely a thought experiment based on the earnings call, not investment advice. Perform your own due diligence. Options are risky.
Got it. Okay, so let's wrap this up. Key takeaways from this deep dive on Lifetime's Q3.
Well, clean beats across the board. Guidance raised significantly, showing management confidence.
Huge focus on capital flexibility, using sale-leasebacks smartly to fund accelerated but higher return club growth.
And that successful strategic pivot, really doubling down on the premium, high engagement, high revenue per member model. They're definitely not trying to be everything to everyone anymore.
No, they're clearly accelerating into that high-end niche. Which leaves us with a final thought for you, the listener, to chew on.
Yeah, the provocative question is this. They've proven this premium athletic country club model works and can drive higher revenue per member.
Right.
But how much higher can they push it?
Right. Is there a ceiling to this premiumization? And maybe more importantly, is the current stock price fully reflecting the long-term asset value they're creating with these huge new high-spec clubs?
If that asset value per square foot keeps climbing as they build out these optimized facilities, maybe that $39 analyst target isn't the end game, but just, a milestone along the way. Something to think about.
Definitely something to think about. That's all the time we have for this deep dive. Thanks for tuning in.
We'll catch you on the next one.